Okay, we are still going to review Alta short put spread review and assignment risk. Okay, so after Alta came out with horrendous earnings and the stock dropped $100 or whatever it was, on August 30th, not 40th, but 30th, we sold the Alta September 6th, 260, 255 put spread, and we sold it for a credit of $3.75. Okay, so what is first off the maximum amount of risk that anybody could have ever had on that? Okay. Yep, so the max risk was $1.25. And what happens to short options when they go deep in the money? Okay, what can happen to short options when they are deep in the money? What does assigned mean? What does assignment mean? Okay, exactly. So if you're on the put side, if you get assigned on a put, okay, so if you are assigned on a put, it means you have to buy stock at the exercise price. So in this case, you have to buy stock at 260 because that was the short put in this spread. Right, Randy? Okay, so what is the offset, the hedge, that we have against assignment risk? The covered position or the long put. Sure, the stock was down to 230, Pamela. Okay, so we have a long put, which is the reason we trade spreads, to always protect ourselves, to always know ahead of time what our maximum risk could ever be. Nope, Dennis, you're almost right on that. You're almost right on that. But being assigned, we had to buy stock at 260. However, our long put allows us to assign someone else stock at 255. So basically, we can sell stock at 255. No, Simon, you got it backwards. We're assigning someone else or putting stock to someone else at 255. Just like someone put stock to us at 260, we are now able to put stock to someone else at 255. Got it. Okay, so what happens then, Randy, is if we get assigned at 260, the worst thing that could happen is that we would have to notify our brokerage house to exercise our 255 put. Exercising means exercising our right to turn that into a stock position by selling that to someone else at 255. So essentially, we bought stock at 260 and sold it at 255. No, we actually wanted it to go up, Kevin. Remember, we sold this put spread. So we wanted the stock to go up, or at least not go down further. Okay, so this right here, this transaction right here, if both options were exercised and assigned, is a minus $5, right? It's a $5 loser. Max value of what the stock or of what the spread could ever be trading. Even if the stock went to zero, that thing would still only be trading $5. Okay, so we lost $5 on that part of the transaction, but remember, we sold this spread originally for $3.75. So Simon's got it. Overall, 5 minus 375, loss of $1.25, which was the, again, max risk we had at the beginning of the trade. There typically are some small assignment fees, Pamela. Although I think now with all the brokerage changes that they've announced over the last few weeks, I think they've actually eliminated exercise and assignment fees. Pretty sure. Hope all is well, Rob. All right, so Randy, does this help you out understanding what happens with an assignment? Okay, if we didn't have the spread, okay, let's say we had just sold the 260 put and didn't have the spread, then you would be obligated to actually put up the money to buy stock at 260 here. But the fact that we had that long put as part of our trade gave us that backstop to just exercise it, turn that into short stock, and then the exercise and assignment both cancel each other out. No, the exchange does not get a piece of the action, John. So, Jerry, if you sell your long put out, you would still have the long stock position from the assignment. That's why you're better off calling your broker and just say, exercise my put, so that it turns into the short stock, which offsets the long stock. Okay, so Pamela, to your question, the key here is saying up here that we sold this spread, meaning we sold the first option here and bought the second option here. Okay. So that helps everybody?